GDP is the big one, a measure of the economy, the size of the U.S. economy, and is it expanding or contracting?
All we often hear about in the news is the headline GDP number. The economy grew at 3.0%. And that's it. And the market reacts to that, and whether it likes it or not. Right. People rarely take time to open up the hood and see what's underneath, because a 3% number can mean very, very different things. But you can actually break it down that way. Now, it takes a little bit of effort because it's not always labeled that nicely, but you can find out what the components that are responsible for driving GDP growth and which are actually maybe not growing. Hi, I'm Patrick Chovanec, Economic Advisor with Silvercrest Asset Management. And I'm here with Rob Teeter, our Chief Investment Strategist, to continue our ongoing conversation about different economic data points and statistics and how we use them and why. And today we're going to talk about gross domestic product, GDP, and tell us what GDP is.
Yeah, so GDP is the big one, a measure of the economy, the size of the U.S. economy, and is it expanding or contracting? And of course, if it's contracting for multiple quarters, people call that a recession. And we want to have economic growth expanding for all of the obvious reasons of it creates an environment where more jobs are created, more wages are paid, more money is spent, companies make more money. The economy growing and expanding is a really critical part of the experience,
so
of the economic experience.
When people use the word economic growth, they're usually talking about measuring as GDP.
Yes, that is the big one. That is the big metric. But the other reason that we really care about GDP from an investment standpoint is that the economic growth backdrop has a very strong influence over corporate profits and earnings of companies. And so when we're looking at the investment backdrop and trying to assess the outlook for equities for companies and their ability to grow earnings, GDP has a very strong influence on that. So we've done some research, for example, that shows that the sweet spot of economic growth is between 1.5% and 2.5%. And in that range, companies are typically able to expand their profits by upper single digits in any given year. When growth in the economy dips below 1.5%, companies have a much harder time posting profits. If it happens to exceed 2.5%, as it rarely does, companies are able to post very sizable profits up into the mid-teens. So from an investing standpoint, the growth metric in the economy and being able to understand, is the economy expanding, is really critically important.
Is higher always better?
Higher is generally better unless it's too high for maybe wrong reasons, or one area where you could say too high might have been a challenge, of course, was the pandemic. So it was high only because it was recovering off a very low base. So those booms and busts and big swings can be very difficult from an investment standpoint. So the slow and steady positive growth is typically a very, very good backdrop to have. But I think it's important for people to understand what GDP is and how it's calculated, and what does that 2% or 3% growth number even mean. So maybe we'll turn it to you, Patrick, and ask, what is GDP and how is it calculated?
So GDP is a measure of economic activity, and really it's meant to measure output, but the way that we get there is by trying to measure spending. Mm-hmm. It's put out by the government quarterly. It adds up then into an annual figure, but usually when we're talking about it as an economic statistic, we're looking at the quarterly release. Mm-hmm. And the quarterly release actually comes out in three phases. There's an initial one where they kind of have some of the data that they've gathered, and they say, we think this is what the economy did. Then there's a second revision, and then there's a third revision, and by the time they get to the third revision, they think they have it nailed down. But that's important to realize because it is subject to revision, and all of these are backward-looking. So this is not a forward-looking estimate of what's going to happen. This is looking back, really, by the time you get to the third estimate, almost a quarter of a year back, and telling us what we think was going on back then. Now, that's still helpful because we maybe are able to spot trends and developments that then allow us to focus on what we're seeing more recently and say, is that continuing? Is that changing? Right. But it's still important to realize that it starts to get a little dated by the time that we're sure what happened in the previous quarter.
Right. And I know one of the things that you like to look at is the different components within GDP. There's, of course, the classic way of constructing it and thinking about it. And then there is an importance to understanding, similar with other economic metrics, what's going on beneath the surface. There are different things that feed into GDP, and some of them might be doing well and others poorly.
I actually think this is very important and often ignored, because all we often hear about in the news is the headline GDP number. The economy grew at 3.0%. And that's it, and the market reacts to that, and whether it likes it or not. Right. And people rarely take time to open up the hood and see what's underneath, because a 3% number can mean very, very different things. The components of what is driving that could either signal that the economy is healthier than what that suggests, or less healthy than what it suggests. Back in economics class.
Yes, I was just going to say, you've spent some time in front of the classroom. Give us
back
the
in economics class,
definition.
we learn in Macro 101 that GDP is C plus I plus G plus NX, which is consumption plus investment plus government spending plus net exports. And if you've ever been to Macro 101, you've actually done that calculation, right? And figured out what that means. But when the GDP numbers are released, you can actually break it down that way. Now, it takes a little bit of effort because it's not always labeled that nicely, but you can find out what the components that are responsible for driving GDP growth and which are actually maybe not growing at the same time others are. So the biggest of those is consumption, and at least in the United States. We're a consumer economy. A large chunk of the contribution to overall GDP growth is going to come from whether consumers were spending and whether that was growing or not. Right. Investment. That actually, I tend to break that down into three different categories. There is business investment, there's inventories, and then there's residential investments, because they actually operate somewhat differently. Business investment is, and it's non-residential investment. That is a good indicator. It's a much smaller portion of the contribution to GDP growth. So if it grows a lot, it won't add as much as consumption growing a lot. Right. But it's kind of forward-looking in the sense it tells you what companies are thinking is going to happen in the future with consumption. So consumption may be growing fast right now, but if investment is down, maybe companies aren't so sure that that's going to continue, and vice versa. Inventory is a form of business investment, but it actually tells you maybe the opposite. So it's a kind of involuntary form of investment. Right. If inventories are going up, you're not selling everything that you're producing. Right. So that's going to carry over to the future. If you may, to sell that inventory off, you may produce less in the future. So it does give you a idea, again, of what might happen in the future. Residential investment is housing. And housing actually makes up a fairly small portion. It rarely adds or subtracts a lot to GDP. But it's one of those things that people looked at because it affects a lot of other consumer behavior, right? Then there's government spending. Government spending can sometimes just, by the way, it's broken down into federal defense, federal non-defense, and then state and local. State and local is a lot more constrained because usually they have to meet their budgets. And if revenue goes down, they have to spend less. The federal government, on the other hand, may purposely spend more if the economy is slowing in order to try to boost growth. Right. And so you see whether the government's actually doing that intentionally or unintentionally and what impact that's having on growth.
And so the last category in GDP is a little bit more complicated.
Right. Net exports. So all the things that we've been looking at so far are measurements of spending. And what we really want to know with GDP is output. Sometimes we produce things that we don't spend money on. We actually export them. Somebody else spends money on. Alternatively, sometimes we spend money on things that we're not producing, imports. So we want to reconcile these two things, and net exports helps us do that. It helps us take the money that we're spending in consumption, investment, and government and reconcile it with what the economy is actually producing domestically. There is a tendency, I think, to see net exports as simply additive or subtractive from overall economic growth. And if we're running a trade surplus, well, then GDP is that much higher. And if we're running a trade deficit, then GDP is that much lower. Right. I don't think it's that simple because net exports, the trade deficit or surplus, is a function of consumption, investment, and savings in the economy and the relationship between them. So the net export number, I think, is better understood as this adjustment to reconcile, rather than something that just sort of floats out on its own.
Right.
It is tied to consumption, investment, whether by the government or private sector, and isn't separate. There are, when you look at net exports, it's useful to say what's happening with exports and what's happening with imports.
Right.
You can have a situation where where there's a shift largely because exports increased or exports fell, and you can have something that's because of what was happening on the import side.
Right.
And whether that was a good or bad sign, it takes a little bit of thinking about. For instance, in the last quarter, imports increased significantly. It shaved 1% of GDP,
Right.
1 percentage points off of GDP. Is that because imports were replacing domestic production and actually decreased output in the United States? Or did it actually boost consumption higher than it otherwise would have been?
Right.
That's where it becomes a little tricky in just seeing net exports as something that we lump on top of the other two.
Right. Exactly. And that's one of the reasons that in a lot of the work that I do in linking the economic growth to earnings growth and investment backdrop, I focus on that consumption piece. So not only looking at GDP, but looking at other measures of consumption. So we have, in today's economy, lots of real-time data around spending. So you can get information from banks and other vendors on how much people are spending on various credit and debit cards in a month. You have metrics on where people are moving about in the economy, where are they spending time, where are they spending money. You have lots of real-time data in certain industries, hotels and restaurants that are publishing lots of information. And from my perspective, that gives a great take on what's actually going on with consumption. And you're right, the other components of GDP might be distorted by different reasons. Inventory builds or inventory drawdowns that can have mixed or confusing signals, and net imports and exports, whether they're moving up or down for various reasons. So I like to really zoom in on that consumption piece and pay attention to what's going on in consumption in real time. I think that's one of the strongest signals as to what's actually happening in the economy as it relates to the investment backdrop.
And that gets to an issue that's very important, which is quality of GDP. We like to think that more is better, but there are some times where, even in consumption, for instance, are we seeing excess of debt? And is this then sustainable? Right. On the investment side, not so much in the United States, but for instance, in China, there's a real question about, okay, if this investment is being pushed by the government, is it really productive investment? It's adding to GDP, but is it really adding to the sustainable growth of the economy, or is there going to be a reckoning at some point?
Right.
We see that with inventory build is more obvious. Inventories can add or subtract a whole percentage point easily from GDP in a quarter, but
and probably
more evident, there's this question of, is it sustainable?
Right. And maybe worth a small diversion there as well when we're talking about inventory, to mention that these numbers are all seasonally adjusted. So we're not getting distortions as, retailers are building inventories in advance of the holiday sales season.
That's right.
That's all seasonally adjusted.
That's right. Government spending is another area where you can question, okay, if the government's going out and spending a lot of money, is this a good thing?
Right.
This is a bad thing. It boosts GDP, but it may worry you if it's leading to either waste or an unsustainable debt situation.
Right.
What you said about seasonality is important, because people should realize that GDP numbers are affected by two things. First of all, they're adjusted for seasonality, and they're also adjusted for inflation.
Right.
at least the ones that we commonly see. So you already mentioned seasonality. I mean, look, there are things that happen throughout the year. People go on vacation during the summer. People stock up on food for Thanksgiving. People stock up on they do a lot of retail buying before Christmas.
Mm-hmm.
If we just didn't make the seasonal adjustment, all of those things would look like the economy is making these wild swings. Right. And you'd think that the week before Thanksgiving, there was this huge boom in people in the economy. So they try to take that out. Right. And of course, there's a method, and people may think that the seasonal adjustment is done well and maybe isn't catching things right. that it should be catching.
And lots of complexities during the pandemic as well, as the economy went through different seasonal effects and the attempts to normalize that and then reverse that as conditions came back to normal. A lot of complexity in all these numbers.
Also adjust for inflation. So there is an attempt to measure GDP deflator to take the nominal growth in the economy and say, okay, some of this is inflation. Now what if prices were the same as they were before? What is this, the actual change in economic activity? But a lot, obviously, assumptions go into that, mm-hmm. and people should realize that when they see a number that says the economy grew by 1.5% this year, it's usually a real GDP number that reflects an adjustment to inflation.
Right. Great. Well, there is a lot going on within the economy, and I think we've covered a lot of different ways of measuring it. In addition to any final thoughts that you might have, I had one last question, which is when someone's looking at these GDP reports, what's sort of a field guide for what they should be looking for? You know, you mentioned a couple of important concepts, I think, which is, you know, focusing on what is real economic growth as opposed to just the nominal number with inflation. What are some of the components that you like to look at within within the economy when you're looking at those GDP reports?
I really think breaking it down to C plus I plus G plus mm-hmm. NX is the starting point. Yep. And actually the GDP reports break it down in a much more complicated way than that. Mm-hmm. So you can, if you have questions, look and see what's going on. But even just taking the short amount of time that it takes to say, what did consumption do? What did investment do? Right. What did government spending do? What did, in particular, inventories do? And what did the trade deficit do to affect our interpretation may end up giving you a very different number that if you kind of say, oh, I'm going to discount this and not look at this and say, well, you know, I think that core growth was actually stronger or weaker than this number suggests.
Right. It gets exactly at that concept you mentioned of sort of the quality of the growth metric. That could have two different numbers that are two similar numbers that mean very different things depending on how you arrive.
There are short-term quality issues that have to do with what's really going on under the surface, and then there are the longer-term quality issues of, is it good that government spending is increasing? Is it good that investment is decreasing? Is it good that consumption is increasing? What do I think about that?
Right. A lot of great things to look at within GDP. I'm eager for the next report to come out so we can dive into it together. So thanks, Patrick.
Good to be with you.